Okay, students, Assalamu alaikum and welcome to everyone in our very first class for this current session, first live revision class for December 2024. So, inshallah, I'll try my best that each and every live revision class should be worth attending. And in a very short period of time, we will try to learn many things. Today's, we are going to discuss two topics. One is the basics of financial management. And second, obviously, we will start cost of capital as well. And let's see how far we will go in cost of capital. And one more thing, obviously, it is just the first class, first week, and either from the second, otherwise from the third week, definitely the frequency of classes will increase. From one, it will go to two classes. But the student, you just need to focus on the instructions, right? And in advance, you will get to know each and everything. Don't worry at all. And let's start. And one more thing, not in today's class. In the second class, I will discuss the three areas which I did discuss in my AFM orientation. What are the three areas where you have to focus in order to not to face any issues when it comes to the theory of AFM? So that will be shared with you in the next class. Okay. And I will try my best that you will get the entire AFM revision in the live classes. But obviously, these classes will only be more beneficial for you if you have already seen the topic, because these classes are the live revision classes. So let's start from a very basic and concepts relating to financial management. If someone asks us a question, let's say someone is asking a question from you, then what is the basic objective of financial management? Either it is a basic financial management or advanced financial management. The primary objective is to maximize the wealth of shareholder. The primary objective of financial management is to maximize the wealth of shareholder. But now please listen and listen carefully. What is the primary objective of financial management? The primary objective of financial management is to maximize the wealth of shareholders. But it does not mean that BOD, they introduce the policies, and due to those policies, they start reducing the necessary cost. Because if you start cutting the necessary cost, then there is a possibility that in the short term, you may get the benefit. But obviously, in the long run, you are not going to get the benefit. So it means, for example, if there is going to be unfair dismissal, so there's a possibility that due to unfair dismissal, you might be having a short-term benefit, but obviously in the long term, you will not have the benefit. So yes, the objective is to maximize the wealth of shareholder, but you cannot ignore all other stakeholders. For example, there is one project which is going to give us a positive NPV. Financially, the project is extremely good. But on the other hand, BOD knows that due to this project, environment will face the problem. Let's say that project is going to emit CO2 emission more than the required limit which government has allowed. One, you will be bearing the penalties. Even after bearing the penalties, let's say the project is still financially beneficial. But how can you ignore the other factors? If it is going to harm the environment, so automatically it will create the bad impact, bad reputation of your organization. So yes, the main objective is to maximize the wealth of shareholders, but you have to consider other areas as well. Now, the next question is, when we say that financial management basic objective is to maximize the wealth of shareholder, then the question is, how do we measure the wealth of shareholder? Now listen carefully how I'm answering this question. The question is, how do we measure the wealth of shareholders? So it is universally acceptable by calculating market value of equity. You can measure the wealth of shareholders. It is universally acceptable by calculating market value of equity. You can measure the wealth of shareholders. Simply, when the market value of equity is increasing, then shareholders' wealth will increase. How do we calculate market value of equity? Simply number of issued shares, ordinary shares, obviously, multiplied by the current share price. So, by calculating market value of equity, we can actually we can measure the wealth of the shareholders. So, if you are a shareholder of XYZ company and share price of that company is increasing, so obviously your wealth will increase. Now, number of shares issued into P naught. P naught is a current share price. Now, very important concept. That is, when we say market value of equity, shares issued, obviously ordinary shares, into P naught. P naught is the current share price. So this market value of equity, which is equal to shares issued P naught, same thing is having two more names. So this market value of equity, which is equal to shares issued into P naught, it is also called market capitalization. Another name for the market value of equity is market capitalization. And it is also called business value also. So when we say market value equity, another name for the market value equity is market capitalization. Another name is the business value. Now listen and listen carefully. Obviously, right now we have not studied business valuation at all, but still, if you have been given a question of a listed company, so whenever you are solving the business valuation question and the given company is a listed company, so obviously listed company will have P naught. Listed company obviously will have the current share price. From where do we get this share price? From the stock exchange. Obviously, if the given company is a listed company, so definitely P naught will be there. So at least if given company is a listed company, at least you can easily calculate market capitalization. But now listen carefully. If given company is a private company, so obviously private companies P naught, you cannot get it from the stock exchange. Why can't we get P naught of a private company from the stock exchange? Because it is not a listed company. So it means at least we will not be able to calculate market capitalization of a private company directly. So we'll be using other techniques. Okay, now come back. Check the question very carefully for a size of the company. Is it a listed or a private? Now, we said the primary objective of financial management is to maximize the wealth of shareholders. Obviously, if the market value of equity has increased, then the wealth of shareholders has increased. If the market value of equity has reduced, then the wealth of the shareholders obviously reduced. The question is, when we are measuring the wealth of shareholders, that is the last point. Don't you think so? There should be financial indicators which are pointing towards maximization of shareholders' wealth. For example, on the result day, obviously those students, they have given the exams, they will get to know how many marks they have got either pass or let's say flung, whatever it is. But that's the last day. Don't you think so? Far, I would say, before giving the exam, there are number of indicators. They just give hint to the students, either you're going to pass the paper or fail the paper. For example, if a student, they have not completed their course, they have not done the enough revision, no practice. So these are the indicators, things will not be good. But someone has completed the course and someone has done a really good practice of the past paper. So these are the obviously and attempted the mock test. So these are the indicators a student is going to perform well. So let us quickly discuss the financial indicators pointing towards maximizing shareholders' wealth. Number one is earning per share. Obviously, if EPS is increasing, so it's a positive signal towards maximization of shareholders' wealth. Dividend per share. If dividend per share increases, again, it's a positive signal. So simply increase in EPS is good. Increase in dividend per share. Return on capital employed, if it is increasing, so that's an indicator towards maximization of shareholders' wealth. Return on shareholders' capital, another name is return on equity. Simply profit after tax divided by total equity into 100. When we calculate return on equity, either it is financial management or let's say an AFM. So the formula is simply profit after tax divided by total equity. But if I calculate return on equity in the reporting paper, then logically from profit after tax, I will deduct the preference dividend as well. But in the reporting paper, not in financial management, not in AFM. In fact, in AFM, EPS formula is very simple. EPS is equal to simply profit after tax divided by total ordinary shares. Obviously, you're not supposed to follow IAS 33 here. Okay. Increase in PAT, again, it is an indicator that shareholders' wealth is going to be maximized. Increase in revenue. Obviously, it is not only the financial indicators where you have to just focus either the wealth will increase or not. There are number of non-financial indicators as well pointing towards maximization of shareholders' wealth. And obviously, non-financial indicators, they are equally important. In fact, I would say most of the time, your financial indicators, they actually depend on the non-financial indicators. Now let's discuss. Look at this market share. Obviously, if the market share is increasing, it's a positive signal for the shareholders that their wealth will increase. Customer satisfaction. If the customer satisfaction rate is increasing, how do we know that customer satisfaction organization is achieved? Very simple. If you are getting repeat business from your customer, if you are getting repeat business from your customer, then it means you have achieved customer satisfaction. Obviously, 100% you will not be able to get repeat business from your 100% customers, but obviously majority of your existing customers should give you the repeat business. For example, I have noticed also, I have not personally used it, but I've seen that normally people, they use iPhone. So I've seen they hardly switch to Android because they have their own obviously reasons, but they say once we have used the iPhone, so now switching to any other phone, they feel it's not good for them. So if this is the case that iPhone customer is not leaving iPhone and Apple is getting the repeat business from the customer, so we will say that you have achieved the customer satisfaction. Quality measures. Obviously, quality speaks. No matter whatever you are doing, if your product does not have a quality, so obviously then it becomes extremely difficult even to, survive. And even I would say, how will you increase the wealth of the shareholders? Quality. As we know that there are number of products, but obviously even in the similar products there are differences in the quality. For example, if you go to the five different coffee shops, you will automatically become in a position where you can decide that which coffee brand is giving us the highest quality. So obviously quality is very important. So it means if the market share is increasing, companies getting the repeat business from the customer, quality companies giving the quality products. So automatically they are indicating that shareholders' wealth will increase. Now, please listen to me carefully. Quality measures. Now listen and listen carefully. Very important concept I want to discuss. For example, your company is in USA, okay? And in USA, you are producing car A. Let's say the name of the car is car A. Now your company has got the opportunity to go to, for example, let's say any African country, okay? And you want to produce the same car in a foreign country. You want to produce the same car A in the foreign country. Now listen carefully. Let's say your company is a well-established company. The brand name of your brand of your product is very high. Your brand is the world well-renowned brand. Even though you're going to produce the obviously same car in the foreign country, and let's say that country is one of from the African countries. Now listen carefully. Customer of that country will be expecting the same quality from you, which you are producing in America. So number one, people will be expecting the same quality. And number two, for you, it will be very challenging to produce the same quality in another country because there are a number of factors. Obviously, you cannot take 100% workforce from America to that country. So you have to hire some of the employees from that country as well. And let's say if you are sourcing the material within that country, so then the question will arise on the quality of the material as well. So it means that whenever we are going to make investment in the foreign country, even though we are going to produce the same product in the foreign country, always keep few risks and number of risks. Out of number of risks, one risk will always be there. That is, will you be able to produce the same quality or not? Another risk is, will you be able to get the desired workforce in that country? So it means quality is very important. So whenever you come across a question on overseas investment appraisal, you can at least write now one risk, and that risk is the quality risk. People will be expecting the same quality from you, and will you be able to produce the same quality or not? Obviously, there's a risk. The above all are the key performance indicators that need to be measured and reviewed, but reviewed by whom? BOD. Obviously, this is not the responsibility of the shareholders. BOD. Now, external factors affecting market value of equity and P naught. So, definitely, each and every factor is not controllable. When it comes to stock exchange, obviously those organizations, they are listed at a stock exchange, the share prices of those organizations just not vary only because of the performance of that business. There are other factors also. For example, if there is political uncertainty in the country, generally the share prices will drop. If conditions are not good in the country, so generally the share prices will drop. So in those circumstances, you cannot make anyone responsible for that. So there are a number of factors which are not controllable, but at the same time, they do affect market value equity, they do affect P naught. So BOD cannot control all aspects that affect market value equity or P naught. One of the major factors is macroeconomic variables. Economic variables, what are they and how directional changes affect the share price? Let's say interest rate, if they fall. Now listen, if the interest rate falls, normally what happens, the demand will increase. And now the question is why the demand will increase. Let me explain. Assuming there is a possibility that your product is so expensive, in order to buy your product, customers, they need financing. So can I say if the interest rates, they fall, they are low, customers will be willing to take the loan and buy your product. So automatically it will stimulate the demand and revenue. Lower cost of debt and improve what? Profits. Obviously, if the interest rate is low, let's say you have taken the loan and you have made the investment. Due to low interest rate, you will be paying less interest, automatically profitability will improve. Investors switch to share market for better returns. Obviously, when the interest rate, they are low, nobody will be interested to invest in debentures. Nobody will be interested in to deposit the amount to the banks if they are getting less interest. They will, in fact, take out the money from their banks, from the debentures, and they will put that money to the stock exchange. Okay. Inflation rate, if it rises, obviously the rise in the inflation rate is not a good sign. Costs rise, causing a drop in the profit. Now, normally people, they think if there's a increase in the inflation rate, if cost has increased for us, so what is the problem? We can increase the selling price. No. Listen carefully. There's a possibility that per unit your supplier has increased the cost by $30. But there's a possibility that you may not be able to increase the selling price by even $30. There's a possibility you might be increasing your selling price by $25. So obviously, automatically your profitability will drop. So all the time, it is not so easy for you to increase the selling price. So sometimes then we have to compromise and the profit will drop. For example, if the petrol prices, they are very high, obviously airlines, they are going to increase the fare, but most of the time it will not be in the same proportion. I would say sometimes they have to reduce their profit. So definitely a rise in the inflation rate is not good for the businesses. When there's a rise in the inflation rate, then it causes the interest rate to rise. Look at this. Rise in the inflation rate causes the interest rate to rise. Basically, when there is a rise in the inflation rate, then governments, they have to increase the interest rate in order to control the inflation. Now there's a question. If inflation rate is high, then how come increase in the interest rate will tackle with the inflation rate? Basically, commodities are always limited. Number one. Number two, if inflation rate is high and we are not increasing the interest rate, okay? Let's say the interest rate is low. Obviously, people will take the loan. They're going to take the loan and they're going to buy the commodities, even though they are very expensive, but since the interest rate is very low, what happens? Commodities are limited. If everyone will have the money at that time, so it will further increase the inflation rate. For example, if assuming in a particular market we have only 5 units and we have 100 buyers, everyone is willing to buy those units. So obviously then automatically prices of those products will rise. Another problem is devalues the home currency. Due to the devaluation of the currency, import will become expensive for you. Obviously, devalue the home currency is good in case of export. But obviously, if you need to import, those economies, they are, let's say, primarily depending on imports. Like our country, we import a lot. We actually import each and everything. Actually, we do not have the power. Otherwise, we would have imported the people as well. Those they're making things in their countries, and we would have imported them come to our country. So basically, we import each and everything. So obviously, due to high inflation rate, okay, there's a question. Sir, can we say that government rise interest rate in order to control money? Yes, money supplies. Yes. And it happened in our country recently. Inflation rate was very high. And interest rate was very high also. And now inflation is coming, I would say, slowly and gradually reducing, not very fast. But we have seen that interest rate is also declining. So simply devalue of the home currency is not good if you want to import from outside, because then import becomes expensive for you. Foreign exchange rate, if it rises means it strengthens. Rises means your currency becomes stronger. When your currency becomes stronger, look at this. Reduces cash receipt for the exporter. In fact, when your currency is very strong, then this thing actually discourages the export. Now the question is why it discourages the export. Let me try to explain. Assuming it happened in our country, of course. I'm not mentioning the name of the audit firm. There was an audit firm. Assuming that audit firm was earning, assuming rupees, let's say 100 million every year. Now try to understand. They were earning 100 million every year. And at that time, assuming previously there was a time when $1 was equal to rupees 100, not now. So it means 100 million divided by 100. They used to remit 1 million to their parent company. Assuming, I'm just a hypothetical example. Then let's say they started to get 150 million. They were earning 150 million PKR, but at that time, exchange rate became 250. If $1 becomes equal to 250, so 150 million divided by 250, it becomes just $0.6 million. Now try to understand. There was a time they were earning rupees 100 million. It was equal to $1 million. And then the time came, they were earning in rupees, they were earning 150 million. But the exchange rate was 250. So when I convert this into dollars, they are coming only $0.6 million. So that was the one of the biggest reason they just went from our country, because of this exchange rate. Because dollar was getting stronger every day, and they had to convert the PKR to the dollar and send it to the parent. So obviously then they said, okay, leave it. So basically when your currency becomes very strong, so it discourages the export. The benefit is import will become cheaper for you. Okay, discourages exporting. We have seen that. Gross domestic product, if it falls, GDP. Just a simple understanding. What do you mean by GDP? For example, in any country, in the entire GDP means the final monetary value of all the goods manufactured, all the services rendered in 1 year by that country. Obviously, if GDP falls, now listen carefully. If GDP falls, it means economic health of that country is not good. If I want to make investment in an overseas country, an examiner has written in the question that GDP of that country is decreasing. So it means there's an alarming sign for me that I want to make an investment in a country whose economic health is not good at all. So fall in the GDP means economic health of the country is not good. Reduced demand and revenue. And look at this, cause interest rate to fall to stimulate what? Demand. Very important point. See, it is the duty of the government, it is the duty of the people that are running the country. If the GDP is reducing, you should decrease the interest rate so that the demand should increase, so that people should make more investment, more businesses should come, so that GDP should increase. General taxation, if it rises, so obviously damages the profitability of the company, not encourage investment by companies. Now, that is why, listen carefully, that is why I would say majority of the governments, whenever they want foreign direct investment, whenever they want other companies, other countries' companies to come to their country, they give tax holidays. What do they do? They give tax holidays. Okay, if you're making investment in our country, let's say you are not going to pay tax for next 5 years, next 10 years, just to give them the incentive to attract the foreign direct investment. So if the tax rate increases, it will damage the company's profitability. It will not encourage investment by companies. More saving, there's only one benefit. If tax rate increases, so obviously there will be more tax savings. Agency problem. Now, this is also very important. The question is, as we know that the basic financial management objective is to maximize the wealth of shareholders. So question is, then why all the time we are not achieving this objective? The reason is agency problem. Obviously, everyone is having their own objectives. So what do you mean by agency problem? Shareholders are the owner of the company. Yes. Expect their directors, agents to take decision to maximize shareholders' wealth. But don't you think so? Directors, they do have their own objectives as well. Actually, directors, they want to increase their wealth also. Why would they always be working in such a way that your wealth should increase? They want their wealth also to increase. And that creates the agency problem. The agency problem occurs when directors take decisions that do not lead to maximize what? Shareholders' wealth. That's the agency problem. Actually, shareholders, they are expecting directors to work in such a way that wealth of the shareholders should increase. But agency problem occurs when directors take decisions that do not lead to maximization of shareholders' wealth. Now, there's a question. What are those decisions which obviously BOD they take and that do not lead to maximization of shareholders' wealth? And second, do they make such decisions deliberately, intentionally, or unintentionally? So let's discuss. Examples of decisions that may damage what? Shareholders' wealth. Number one, directors' pay. Of course, the director's pay is very high. Very high. So that is why majority of the shareholders, they say it's unfair. Sometimes they complain, they say that directors are working for the company or company is working for the directors. So directors' pay is very high. Taking high risk business decisions. This is very important. Taking what? high risk business decisions. Now you need to understand here few things. What we have written, taking high risk business decisions. Now you might be thinking, sir, if my BOD, they are risk averse, let's say they have the attitude of risk averse, they don't want to take the risk, then how can you say that they will be taking high risk business decisions? Let me tell you, when you are working as a director, okay, sometime the business come across, or the business faces, I would say, challenges where they have to make the decisions. No matter your BODs is a risk taking management, or your BOD, they are risk taker, risk averse, but you have to make the decisions. If that decision proves wrong, then obviously consequences will be definitely, wealth of the shareholder will reduce. If those decisions they prove right, then wealth will increase. For example, there was a time when BlackBerry, they introduced the cell phone, and within that cell phone, they given the facility of, sending the email, receiving the email, the way back. So obviously that model, I would say in no time, everyone was having that cell phone, especially the business community. So it means that at that time, BlackBerry got the success. But immediately after that success, there was a news that smartphones are coming in the market. That is, let's say Samsung and iPhone, they are about to introduce the smartphone, touch screen phone. So at that time, BlackBerry had to decide either to go towards smartphone or to just carry on with their existing design. So the BlackBerry, they went with their existing design. And obviously later on, it proved that their decision was a disaster. And same thing happened with Nokia. They did not ship timely on Android. And look at this, the Nokia is nowhere. Even though there was a time, 1 decade, 10 years, Nokia was the king in the mobile industry. And now there is no more Nokia. So you have to make decisions. Non-payment of dividends, obviously shareholders, they believe that their wealth is being damaged. Using debt finance against the wishes of shareholders. See, the business is already having a high debt. And if you're going for more debt, and shareholders, they don't want you to take more loan. Obviously, when you will be taking more loan, you have to pay more interest. And due to this interest payment, shareholders, they will face the financial risk. Obviously, interest payment, it brings volatility to the return of the shareholders. So especially when you're using debt financing against the wishes of the shareholders, they feel their wealth is being damaged. Now, what are the solutions to this problem? One is obviously company law. We have the corporate governance. We do have the rules for BOD. But in our syllabus, the very important point is share option schemes. And obviously, if you have studied SBR, if not, you will study. So in SBR, you do study the entire IFRS, that is IFRS 2, share-based payment. But now let's discuss here share option schemes. Basically, organizations, they provide share option schemes. The objective of share option scheme is to reduce this agency problem. Now, what do you mean by share option schemes? Executive share option schemes are designed to incentive both managers and members of BOD to maximize shareholders' wealth. For example, assuming, let's say, if company is given share option schemes to their managers, their BOD, assuming everyone will get 50,000 shares. Let's say the exercise price is $20, and assuming current share price is right now $12. let's say each manager, each BOD will be able to get 50,000 shares and they just need to pay $20 per share. Right now, the current share price is 12. And let's say time period to exercise this option scheme, assuming it is 2 years. Now listen carefully. Each manager, each director, let's say, can get 50,000 shares. Exercise price is $20. But the current share price is $12 and time period is 2 years. So within next 2 years, they can buy 50,000 shares by paying $20. Now listen, can I say BOD managers, they will try their best to increase the share price because logically, BOD and managers, they will only be able to get the benefit when the share price is going to be more than $20. For example, end of second year, if share price becomes $45, how much they will be paying? Just 20. So per share, they'll be getting a benefit of 25. If the share price becomes 35, they will be paying 20. Still, they will be getting a benefit of 15. And it is not only the BOD and managers, they will be getting the benefit. Obviously, the shareholders will get the benefit also. How? When this scheme was given, at that time, the current share price was 12. And let's say when managers and directors, they are exercising the share option scheme, share price is 45. So due to introducing this executive share option scheme, it is not only the BOD and managers, they will be getting the benefit. Obviously, the shareholders will get the benefit as well. And we have discussed by measuring the wealth of the shareholders. How do we measure the wealth of the shareholders? By calculating the market value of equity, we measure the wealth of the shareholders. Obviously, if the share price increases, so wealth of the shareholders will increase. And obviously, when the wealth of the shareholder increases, this is what we actually want. So it means due to the introduction of share option schemes, companies, they try to reduce agency problem. And let me tell you one more thing. These share option schemes we always provide call option to the managers, to the BOD. Call option means we always give them the right to buy. So whenever we want agency problem to be reduced, so we are going to introduce executive share option schemes, and under those executive share option schemes, we will actually give call option schemes to the BOD and the manager. Call option means right to buy. We never provide put option scheme to the BOD and the managers because put option will actually create the agency problem. Put option means right to sell. So if you want your agency problem to be reduced, you will always introduce executive share option scheme, and under this executive share option scheme, we will give call options to our managers, to our BOD. And now listen here carefully. How do we actually value the option? Either it is a call option or put option. We use BSOP, Black-Scholes option pricing model, which is available in our syllabus. And it is available in our syllabus. Now listen carefully, student, listen carefully. After the introduction of BSOP calculator, now the calculation of BSOP has become extremely easy. Those they have actually seen lectures on BSOP, let me tell you. Now we have the BSOP calculator, and what BSOP calculator does, all you need is just give the 5 variables to the calculator. That is PA, PE, RST, and automatically calculator is going to calculate the value of D1, D2, ND1, ND2 call and put option for you. Now the entire exercise of BSOP can be done within, I would say, 2 minutes. And one more thing, I have made one video. I think within just 4 minutes, all the major shortcuts of AFM I have covered, and you will find the BSOP calculator as well in that video. If you have not seen that video, please do ask in your WhatsApp group from the admin that please share the video of shortcuts. So within 4 minutes, you will be able to watch all the shortcuts. No. See, we never give put option to our directors. It will create, put option means right to sell. Now listen carefully. For example, the current share price is $20. Exercise price in put option is $18. It means they can sell it for 18. Now, logically, your BOD and managers, they will be interested in the reduction of share price. They will be interested in the reduction of the share price. Now, try to understand. For example, every manager can sell 50,000 shares to the company. If share price drops to $10, what are they going to do? Listen, they will buy the shares for $10 and they will sell to the company for $18. So we never provide put option scheme to the managers. We always give call option scheme to reduce the agency problem. There was one more question. Let me take that. What is that question regarding? Yes, BSOP calculator is available in exam. Obviously, it is available in exam. If it is not, so why we are discussing? BSOP calculator is available in exam, no doubt about it. And of course, AFM. P4 is a very old name. 5 key decisions to maximize the wealth of the BOD, to maximize the wealth of the shareholders. To maximize shareholder wealth, BOD must consider the following. Obviously, the investment decision, finance decision, dividend, risk, and ethics. And each and everything is in your syllabus. In investment, obviously, cash is a key source for a company. It can be allocated and used 2 types of investment. One is organic growth. Second, you can say inorganic growth. Both types of decisions you have to study in really good detail. Finance. Company needs to raise cash for 3 main reasons. Finance the investment is stated above. That is organic, inorganic growth. To enable the company to pay dividends and bolster the liquidity position of the business. To improve the liquidity position of the business. Sources of finance, equity, debt, Islamic. Obviously, we have to discuss this in really good detail. AFM. Past question have tested this area in 2 ways. Knowing the key points on each source of finance, cost of capital, obviously we are going to start. Dividends, as stated above, cash can be allocated to pay dividends to the shareholders. The dividend decision taken by BOD is not straightforward. As it seems, the creation of dividend policy is affected by several factors. Obviously, you have to study each and every factor of the dividend policy. Risk. The BOD has the responsibility to identify the risk that will affect the entity. Put into force risk management strategies. There are 4 major risk areas tested in ACCA AFM: business risk, financial risk, foreign currency risk, interest rate risk. Each and everything we are going to study in great detail. Okay. Ethics. The BOD cannot simply take decisions that maximize shareholder wealth and ignore all other stakeholders. They must be aware of how their decision will impact upon others. So candidate must identify the key stakeholders, specify the impact upon them of decisions taken by the BOD, and basically this is 3 steps approach how to answer the ethics area. Identify the key stakeholders. They will be affected by your decision. Then what impact? Specify the impact upon them of decisions taken by the BOD. And obviously how you can mitigate with appropriate strategies. Identify the key stakeholders. Specify the impact and how will you mitigate. For example, assuming government of Dubai, okay, let's say they want to introduce the new, I would say, metro system. And due to the introduction of the new metro system, they have to demolish, let's say, 100 houses. So number one, only 100 houses will be affected. What will be the effect? They will lose their homes, their houses. How to mitigate? Number one, government should inform them far more, I would say, ahead of starting the construction for that metro. Number two, replacement houses, more or less with the same, I would say, standard houses, more or less, similar class area. So if you're providing more or less, let's say, for example, someone is living in a bungalow. If that person is going to get the bungalow in another place, and that area is having the more or less the same worth, uh, is having the same worth like the existing area. So obviously, this is how you are mitigating the losses. Plus, if I would say government should provide at least few months free school shuttle to the children. Obviously, they will be affected as well. So identify the key stakeholders, specify the impact, and then you mitigate how to mitigate those, I would say, problems they are going to face by certain stakeholders. Now, just what we have discussed, now you have a really good idea, at least regarding few things. For example, if interest rate falls, so what impact it is going to have on the business? If there's a rise in the inflation rate, what impact will it is going to have on the business? Fall in the GDP. You know that fall in the GDP is not good. It shows economic health of that country is not good. Plus, if your home country's exchange rate becomes strengthened, so it actually discourages the export. If your currency is getting devalue every day, so obviously import becomes very expensive for you. So we have discussed number of theoretical areas. So you can see that, students, so far no calculation. We have discussed each and everything regarding theoretical areas, and we have touched number of areas. And at the start of the class, I did mention 3 areas where you have to focus in order to make your AFM theoretical area very strong. And I can guarantee you, if you have a really good focus on those 3 areas, automatically, I would say your theoretical area will be just great. And I'm going to mention where to focus for that 3 areas in the next class. Don't worry at all. So now let's start. Cost of capital. Okay, in cost of capital, let me first jot down the topics, what exactly we need to revise. Obviously, CAPM, DVM, MM plus tax equation with change. We will discuss CAPM with change. How to calculate, let's say, current WACC, how to calculate risk adjusted WACC in case of diversification, how to calculate WACC of a diversified business. The business is already diversified. Companies already diversified. And how to calculate risk adjusted back when proxy company, competitor, is a diversified company. So this is what we actually need to discuss. We need to actually revise in our cost of capital. So even though it's a live revision class, but I've written almost all the topics, what exactly we are going to revise in this area, cost of capital. Now let's start. Obviously, we cannot complete each and everything in today's class, and it is just the first class. So you have to be little bit patient. You need to have a patience also. So that slowly and gradually, obviously, we'll discuss each and everything, inshallah. And whenever we are going to discuss, I would say any topic. So before the discussion of the topic, I'll write each and every points what we are going to discuss. Okay, don't worry at all. And just give me a minute, please. I have to submit the just 1 minute only. Okay, students, let's quickly discuss cost of capital. Okay, cost of capital. Another name is weighted average cost of capital. Number one question. What is the objective of cost of capital? Actually, objective of cost of capital is investment appraisal. The objective is investment appraisal. So obviously, if there's no investment appraisal, there's no need of the cost of capital. So the objective of cost of capital is investment appraisal. And second point, cost of capital. Actually, cost of capital represents cost of financing. What it does, repeat, cost of capital represents cost of financing. Obviously, in order to make investment, in order to make investment, you have to raise the finance. In order to make investment, you have to raise the finance. And obviously, each source of finance will have their own cost. So number one, the objective of cost of capital is investment appraisal. Number two, the meaning of cost of capital is cost of capital actually represents cost of financing. Now, if your company raises the finance in the form of equity, then cost is cost of equity, KE. And this KE can be calculated by using capital asset pricing model, dividend valuation model, and plus tax equation, obviously with the change. And we will discuss the reason when actually we will be using this plus tax equation. If your company raises the finance in the form of debt, then the cost is KD1 minus T, cost of debt after tax. Why cost of debt after tax? Because when company raises the finance, they have to, in the form of loan, they have to pay interest, and definitely interest payment results in tax saving. That is why we say KD1 minus T. Obviously, when we'll be discussing this KD1 minus T, so we will be discussing all types of debts. Like debt could be a bank loan, it could be the straight debt. Straight debt means straight debenture. Straight debenture means without conversion option. It could be convertible bond, it could be redeemable bond, it could be irredeemable bonds. So when it comes to debt, it has varieties. We will be discussing KD1 minus T for each and every type of debt. Third and the last is preference shares. Obviously, there's a possibility your company is going to raise finance in the form of preference shares. So in case of preference shares, The cost is KP. Obviously, when we'll be discussing preference shares, if your company raises the finance in the form of preference shares, the cost is KP. And when it comes to preference shares, interestingly, there are two types of preference shares, redeemable and irredeemable. We will discuss, don't worry at all, how to calculate KP for irredeemable preference shares, how to calculate KP for redeemable and irredeemable preference shares. Obviously, for both, the techniques are different. But student, since it is just the first class, I don't want this first class to be very long. I just request one, please do give the feedback of today's class in your respective WhatsApp groups. It motivates tutor as well as other students, so that other students should also get encouragement to attend the live class. I hope that you have enjoyed this class. Yes or no? I have no. So you can comment. Okay, that's great. I hope Bob Ryan was a very old examiner. Class is just over. Last minute is happening. Just the last minute. So since it's a first class, so I don't want this to be very long. Okay. So students, thank you very much. See you all and others as well in the next class. Okay, students. Thank you very much.